We will have those corrections. So again, we just keep our eye on the prize. We have a 5-year time horizon. We are fully invested at all times, which is what we are supposed to be. But that doesn't mean that investors shouldn't, sometimes take a bit of money off the table and keep some powder dry.
I know you're aware, Cathie, that the market doesn't give second chances to superstar managers who stumble. Ken Huebner is one who comes to mind, right? He was never able to rebuild the asset base that he had before the financial crisis. Neither was Bill Miller, for that example. Is that something that concerns you, the consequences of having a bad year?
Well, one bad year would not worry us at all. Our investment time horizon is 5 years, and we have projections which we develop from the top down, trying to understand how technologies are going to scale, and from the bottom up, how companies are going to embrace these new technologies and ride their coattails. And just looking at the portfolios today, this is after the triple-digit gain, as you have said. For the next 5 years, we believe that our returns will compound at an annual rate of something in the low 20% range. And this is in a market where traditional equity returns have been in the 7 to 8% range over time. So we still think there's a lot of room or runway ahead because what we think is not well understood is exponential growth. I think if we step back and look at Amazon in the early 2000s, I remember buying that stock, and many people derided that decision because the thought process back then is in the tech and telecom bust, which is, the internet is a figment of Wall Street's imagination. What makes you think Amazon's ever going to make any money? And if you did at that time assume that Amazon's revenue growth would compound at a 20 to 30% rate for the next 20 years, you would have bought that stock all day long, even if you were using a dividend discount model, right? I feel like our portfolios are filled with Amazons because the seeds for what we are doing now, they were planted in the tech and telecom bubble, and they have been gestating all this time, and now they're breaking out to those growth trends, just like Amazon did.
So the portfolio may not be able to replicate the 500+% gain it's had in the past 5 years, but it should be, based on what you just told me, well over 100%. It should double plus in the next 5 years.
Yes, we expect more than a doubling in our portfolios over the next 5 years.
If I look backward, as you well know, Tesla accounts for almost a fifth of the return that you have generated in that 5-year time span. Which of your current holdings, Cathie, do you think will supply the biggest lift in the next 5 years?
Tesla's still in the running, but I would have to say the biggest upside surprises are going to come from the genomic space. And that's because the convergence of DNA sequencing, artificial intelligence, and gene therapies, importantly CRISPR gene editing, are going to cure disease. That convergence is going to cure disease. Now we have real science and technology surfacing the mutations in our genomic profile. And as they surface those mutations, what do we see? We see the earliest manifestations of disease. And now, with the combination of artificial intelligence and gene editing, we're able to both anticipate diseases and cure them potentially. Beta thalassemia, we're seeing it, sickle cell disease. We even think it will work in diabetes, which is where most, if you look at the largest category of spending year to year in healthcare, it's diabetes.
Cathie, another surprise for me in your portfolio attribution is that almost none of your performance, just 20 points out of 600 points, is from Apple, Microsoft, Amazon, and Facebook, the 4 biggest contributors to the S&P 500 over the same period. What about them doesn't make the grade for Cathie Wood and for ARK?
Well, we're not saying they'll be bad stocks at all. In fact, they've been very good stocks. And they were a part of our portfolios in the early days. But as they were scaling into the trillion-dollar category, we believed that that our research would be focused better on the next set of fangs. And I don't mean fangs meaning in the internet age. We actually think the next fangs are in the genomic age. And if you'll notice, our flagship portfolio, the largest exposure is healthcare for that reason.
What would make you reconsider investing in those stocks?
What would encourage us to move back into that ilk of stock is a continuation of what we're seeing now, so that some of our valuations become stretched beyond our minimum hurdle rate of return. So our minimum hurdle rate of return for any stock entering our portfolio is 15% at a compound annual rate over the next 5 years. So that's the doubling over 5 years. We're not there yet, but if we're in the low 20s, which is much more than a doubling over 5 years, but if we started seeing more and more of our stocks lose that return expectation and drop below 15%, we would move back towards some of the FANGs and Microsoft because we would be treating them essentially as cash-like instruments for our strategy. So what we do is, as a bull market extends, we do move into more cash-like equities. They would be the less volatile stocks, and certainly the FANGs and Microsoft fit that. And we would do that increasingly.
Bitcoin historically was a huge contributor to your returns, and I know you're still bullish on it because ARK recently published 2 very favorable white papers on Bitcoin. But so far as I can tell, there has been no Bitcoin in the ARK Innovation ETF for more than a year and a half. How come?
Yes, well, we put it in at a 1% position in 2015 when Bitcoin was $250. And we scaled with it. We didn't sell it at all. So it hit 10% of the portfolio, at which point we were forced to sell. And at the same time, there was some forking taking place. So we were getting distributions. And what we learned is that Bitcoin threw off what's called unqualified income, which is not illegal, but from an IRS point of view, if our portfolios generate more than 10% of gross profits in unqualified income, which is usually commodity-like income, the IRS allows that 10% and then will confiscate the rest of it. So if we moved into a black swan event where the equity markets imploded and Bitcoin took off, our clients would be able to keep only 10% of that gain. And we just thought this was too much of a risk from a fiduciary point of view to subject our investors to. So what we did is we moved out of it in early 18, better lucky than smart, because of course we went from $20,000 down to, at the end of 17, down to below 4,000 earlier this year. In our fully discretionary portfolios, where we are not subjected to the 40 Act rules of the SEC, our Bitcoin position is about 7% right now. So that is how optimistic we are on it.
And it's once again flirting with $20,000. Can you put a price on your level of bullishness?
We are extremely bullish. Our confidence in it has gone up since 2017, because what we saw as it dropped from 20,000 to below 4,000, it actually got well into the threes, I think in 2019, was that Bitcoin's share of the crypto asset ecosystem moved from the low 30% range in terms of value, network values, into the low 70% range. And what did that tell us? That confirmed in our mind that Bitcoin is the reserve currency of the crypto asset ecosystem. So it is the reserve cryptocurrency, which is a very important role. It's the flight to safety currency. It is Bitcoin's technology or Bitcoin's blockchain is the most secure of any other blockchain. And so it makes sense that Bitcoin would be the reserve currency of the crypto asset ecosystem.
Cathie, in August of 2018, you tweeted a letter to Elon Musk in which you effectively put a price target on Tesla of $4,000. And that call arguably made you famous, but it also exposed you to a world of hate on Twitter. Any regrets?
Oh, no, not at all. I didn't read the Twitter world of hate notes to me. Our marketing department used to send me anything that I needed to respond to. But no, we were standing up for what we thought was right. And we also were astonished that at the backlash. And I think part of it was Elon's personality and the way and the things he was saying on Twitter. He's a provocative soul, you know, and he's brilliant. He's our Renaissance man, and all we did, which is what we should have done in terms of our research, is keep our eye on the prize, and the prize had to do with the autonomous taxi network that we believe Tesla will be in the pole position to dominate, mostly because of its advantages in artificial intelligence and the amount of data it has collected and the AI expertise that it has. And we couldn't believe that no one wanted to listen to this, that they really just made fun of it. And it made me feel even more strongly about Tesla, because what we saw happen over time as the naysayers were growing was their barriers to entry, or Tesla's barriers to entry, were increasing. Their battery technology was already 3 years, now it's maybe 4 years ahead of the competition, especially now that they're going to build the battery into the structure of the car. They had the first AI chip. No other auto manufacturer has an artificial intelligence chip for autonomous. They now have 15 billion miles of real world driving collected. Google, the next closest, has about 25 million, 15 billion. The winner in autonomous is going to have the most data and the highest quality data. That company right now is Tesla. So way back then, our confidence was high that they were heading in the right direction. And as the naysayers grew, it was after 2018, through into 2019, as the stock was cratering, as many out there were saying Tesla was going to run out of money. We thought that was a ridiculous concept. The only time a company like Tesla will run out of money is if the market shut down. There were companies that ran out of money in 08-09 because the markets were closed. The markets were open. We were going to support Tesla if they did an offering. So were many others. So, I mean, they were creating stories that were just ridiculous on the face of them. So, you know, no regrets whatsoever.
Tesla is a great example of how you and your colleagues have harnessed social media as a tool for marketing, a tool to disseminate your ideas. Where do you figure ARC would be today without social media?
I don't think we would be as far as we are. I know we've been very gratified to see how beautifully we're scaling and getting our message out, which has helped our distributors, because we have a distributor here in the United States, one in Japan, who distributes for us through Asia Pac. We are known throughout the world. We are punching so far above our weight because of social media. And what's been fascinating about it is it has given us a competitive advantage because the compliance departments in other organizations will not let their portfolio managers or analysts talk about their research. We can't really talk about our stocks too much, but we can talk about our research. And that is giving us a competitive advantage in two ways. The reach that I just described, but also we're becoming a part of the communities we're researching. Our analysts, as they put out their research, not when it is finished, but as it is evolving, they are engaging with the communities who are actually making these innovations happen. And it's a beautiful dynamic, because what we're doing is we are educating those innovators about how big their markets are going to be, how quickly they will scale, where the barriers to entry are likely to be, what the competition looks like. And they are battle testing our assumptions. They're telling us if we've made an incorrect assumption, or they're telling us if we've got the technology right. So it's an incredible give and take. And I always thought that open source research, much like open source software, would be a very powerful dynamic in the marketplace, and it has been.
So hazard a guess for me. You've got 30 plus billion in AUM today. How much, where would it be without this community that you've created, and the velocity that being on Twitter has provided?
Well, to be honest, we're up to 50 billion now.
Oh, if you add all the separately managed accounts and the institutional money.
Accounts, all the different strategies. I think we'd be a lot smaller than we are now. And I think that, what comes around, or what goes around comes around. We have really, with outreach as one of our ARC's missions and values, we have wanted to educate people, the average investor, about how their lives were going to change and how they might capitalize on these changes in their portfolios. And so I think there's a virtuous cycle at work here. And there's also a bit of a viral network effect taking place, which I think many in the financial world did not think could be a part of the financial world, just because of our regulatory regime and so forth.